Hello viewers, my name is Sipokazi Majambe. I am from Etimbini Enrichment High School. Welcome to the ECDoE broadcast studio, and today's lesson is going to be on corporate governance and ethical behavior. It is very crucial that you understand this topic and that you try to maximize your marks in your NSC exam. In front of us is the topic overview. You can see that this is a paper 1 topic in the NSC exams. If you check all the previous year's question papers, 2021 all the way to 2024, you'll find this question under question 4. Okay, so normally it's question 4, it's about 15 marks of your paper 1 exam. The focus of this topic is on the financial environment, or how the financial environment is going to be managed as well as controlled in a public company. It focuses as well on the key stakeholders that we are going to be finding in business: management, the board of directors, shareholders, and as well as the auditors. This topic is also going to focus on unethical behavior. So we are now looking at the lesson outcomes for today's lesson. So what you should be able to do for me by the end of this lesson is to define corporate governance, explain why it is important, and list the different stakeholders that are going to be involved in corporate governance, as well as explain the roles of the above in good corporate governance. Okay, so let's define it quickly. Okay, so the meaning of corporate governance. Okay, so corporate governance refers to the way in which a company chooses to govern itself. Okay, I want to highlight that word for us, govern. Okay, so where have you heard this word before? I'm sure you're thinking about government. So we know in our country, in South Africa, we have the government. And who are they? They are people who have been elected into power, right? They come with the rules and the regulations and the laws to keep us safe as the citizens of the country, and to regulate basically the country and the operations of the country, so that we live a good quality life in South Africa. It is the same with companies. Companies need to have people that are going to govern the companies. They need to have a system, which is a set of rules, procedures, practices. They need policies that are also going to govern the way that the companies are going to be directed and controlled towards achieving the goals and the objectives of the company. Slide, we are going to be looking at the key stakeholders as well as their roles. We are going to start off with shareholders. The reason I want us to start with shareholders is because shareholders are very crucial to companies, because that's the form of ownership you're doing in matric. They are the owners or the investors in the company. They have ownership, but they don't have control. Okay, so you need to understand that. Yes, they've invested their finances and funding into a company, but they don't have control, because shareholders are ordinary people. They don't, for example, if we bought shares at Coca-Cola, you wouldn't really go and work for Coca-Cola now, would you? The past forms of ownership that you've done, for example, a sole trader or a partnership, you've seen that the owner also controls or manages his business to some extent. However, with public companies, there is no control, because you own, you buy, you invest, you buy shares, but you leave your company to the control of certain elected individuals. And we are going to be looking at those individuals in the next slide. Now, because of the stewardship that you've handed over to these individuals, you are going to need, as a shareholder, external assurance to protect your interest, to protect the funding that you've invested in this company. Shareholders have voting rights. They also have the power to elect or re-elect the directors, and they have the power to approve the directors' remuneration. Directors come highly qualified. They are your chief financial officer, your chief executive officer, your chief marketing officer. These high role managers, they are your human resources manager, so they need to have a lot of skill and care when they are performing their duties. They're put in a position of trust. They should not be party to any fraudulent activities. Again, directors are at the top, and anything will trickle down to the bottom. So the ethics that they have, if they are the ones who are part of fraudulent activities in a company, then it means that that culture is going to trickle down to the lower level employees. So we really, under no circumstances, want to have directors who have poor morals and ethics and who are involved in fraudulent activities. Then the next one I'm going to look at is that number 6, it says that they should not make false statements or falsify the books of the company. The case in the United States of a company called WorldCom. It's an old case. In 2005, you can consult your New Era textbook where you can find a number of cases that will help you to engage more with this content. And in that case, the director of this company instructed his subordinates to make false statements and basically to cook the accounting books. At number 7, they also have the responsibility of establishing board committees. This is according to Section 72(1) of the Companies Act. So yes, companies are mandated by the Companies Act, which is the legal companies are mandated by the Companies Act, which is a law that asks the companies to establish board committees. Let's now look at some of the board committees. There are 5 board committees. One that you can't see on the screen is the nominations committee, but basically I'm going to be focusing on what we can see on the screen. The first committee is the remunerations committee. Next, you have the audit committee. You also have the risk committee, as well as the social and ethics committee. Please pay close attention to the tasks under each committee. Imagine with me one more time that you are the matric class of 2025. So I know there are certain events that you have the responsibility of hosting. Say you had to host a Valentine's show. Now you are a big group of matriculants. It would be hard for you guys to plan all together the different key areas of your matric dance or even a Valentine's show. Let's scale it down. Let's say you have to prepare for a Valentine's show at school. Now, it would make your work more effective if you guys split yourselves into different committees. So the committees will allow you to effect your duties or to implement your duties more effectively. And how you would split yourself into those committees, you would have regard to your skills as well as your areas of interest. It's exactly the same with public companies or companies in general. The board committees allow the board of directors to be more effective because the directors can now choose which board or be, because now the directors would fall under one of those committees. So the remunerations committee has the responsibility of reviewing the salaries of directors, their bonuses, and other earnings of directors. The companies need to have regard to the planet whenever they are conducting their operations. They must not conduct operations in a harmful manner to the environment, and therefore there'll be certain legislation around that. Okay, the legislation is going to tell them there'll be certain legislation about that, and they need to adhere to that legislation. They might be fined if they don't follow that legislation. So the risk committee is going to look at all of that and ensure that the company is in compliance with all the environmental laws and regulations. Then the final board committee is the social and ethics committee. And here we are merely monitoring good corporate citizenship. This committee ensures that the company is going to operate in an ethical and socially responsible manner. Remember, companies do have a relationship with the community. They employ employees that come from the community, and they operate in a community dealing with various stakeholders. So they always have to be socially responsible in their dealings with all of these different parties that they engage with. So something also that's very important that you should know about the board of directors is that they are split into 2 types, which is the executive directors and the non-executive directors. The only difference between the two is that our executive directors work on the day-to-day basis for the company. So you'll find them Monday to Friday, 5 days a week, 52 weeks in a year working in the company. They are salaried employees of the company, while the non-executive directors have a degree of independence. Okay, they provide objective judgment. They serve as advisors to the executive directors, and we call them the watchdogs. Okay, so we have to nominate or elect non-executive directors. The last stakeholder that we are looking at is the auditor. Okay, we have two types of auditors in companies, internal auditors as well as external auditors. So the internal auditors are trained professionals that are employed by the company, and they provide independent and objective evaluations of financial and operational business activities. It is a framework, and it's called the King Code of Governance. It is a guideline that is going to encourage ethical business practices. Okay, so when something is a framework, it basically means that it's something that we can refer back to. It's going to give guidelines to the directors or to whoever is running a corporate company on the principles of good governance. Its key areas of performance is that it's going to focus on the triple bottom line. It's going to look at the people, the profits, as well as the environment. So companies are vulnerable to bad corporate governance due to that separation of ownership, sustainable. And then the next one is transparency. We have accountability, responsible management, discipline, independence, as well as fairness. We need to come up with an acronym so that you guys can remember these principles. So S for the first one, for sustainable. T when we're speaking about transparency. A for accountability. R for responsible management. D for discipline. I for independence. And F for fairness. Again, the acronym that we come up with that can be useful to you when you're answering past question papers is the acronym of STAR-DIF. Okay, STAR-DIF. So whenever you're doing a corporate governance question, there's going to be issues of unethical behavior. So rather than you saying this is unethical all the time, which sometimes only amounts to 1 mark, I would like you to read through the question paper and identify the principle that is in breach. Okay, so what are the directors in breach of? Is it an issue of irresponsible managers? Is it an issue of independence, fairness, or is it that the directors were not transparent? So on the right-hand side of the table, there we explain the principles a little bit more. So the first principle says that businesses need to operate in a way that does not jeopardize our current and future social, environmental, and economic well-being. An example of that would be that businesses must use resources in a way that they don't exhaust the resources, okay, so that they keep them for future generations. They use the resources in an efficient way. Transparency has to do with conducting business in an open manner and without having any hidden agendas, not withholding very important information that might influence the decisions of key stakeholders. To be accountable means that directors and officials are kept responsible for their decisions and their actions. Okay, so they can give account that the financial statements, for example, were prepared in accordance to GAAP as well as IFRS. Okay, they can be accountable when asked. Responsible management is going to involve conducting business activities with care and with regard for the interests of all stakeholders. And discipline speaks about the commitment that the leaders need to have to behave and carry out duties in a correct and proper manner. Independence has to do with objectivity, okay? It has to do with your objectivity and your unbiased interactions or opinions. You must not be swayed by external influences. And fairness has to do with treating everyone fairly or equally, not prioritizing certain shareholders or stakeholders over others. Fairness has to do with being objective and being fair, okay, being equal, being impartial, and free from any bias and dishonesty, and not favoring one shareholder over another, but treating all shareholders or stakeholders equally. Now we are going to be looking at a question paper. This was the trial exam of 2024, your accounting paper one. And as you can see, as I've said, the question is going to be question 4 and the marks is going to be 15 marks. Please give care to the time. You can start with this question, put your 15 marks in the bag, and then go to question 1. If we read from the trial paper, they are speaking about the financial results which could not be relied on. Okay, this was after external auditors from day on stated that they were unable to express an opinion on the reliability of the company's financial statements. They found that 10 executives, so if we're speaking about executives, we're speaking about the board of directors as well as other managers in the company, including the former CEO, inflated profits to boost their own financial incentives. This resulted in the company's equity being overstated by 4.5 billion rand. Okay, that's a huge sum of money. Among other things, they recognized revenue income in earlier accounting periods than it should have been recognized. Okay, moving on to the next paragraph. The Kruger investigation identified problems including governance practices, okay, record keeping, system usage, as well as financial reporting. Okay, so these were the issues upon investigation from Kruger investigation. These were the issues that were picked up. Nicole Limited, which is the company we are talking about, asked that its listing be suspended to protect its investors against speculative trading. The JSE then suspended their listing. No one could buy or sell their shares. So when a listing is suspended on the JSE, it means that the shares of that company are not going to be traded at that particular point in time. And this was from June 2023 onwards. Okay, so the JSE started trading the shares in February and they fined them 7.5 million. Since then, okay, this is key, Nicole Limited, the company, decided to hire Zentech to be their internal auditor. This is the first time that they are mentioning an internal auditor. And Dion was Nicole's external auditors for more than 15 years. Okay, they're telling you that for a reason. So let's look at the required. 4.1 asks us to explain why Nicole Limited needs the services of both an internal and an external auditor. Okay, so if you remember in the last lesson, I did explain that an internal auditor and an external auditor have different functions to perform in a company. So internal auditors are responsible prior to the audit of financial statements, the external audit of financial statements. The internal auditors are going to be taking care of the internal controls of the company, the internal control process, and they are going to audit financial statements internally before an external audit is conducted. They also oversee the preparation of financial statements, and you get your 2 marks. So 2 marks for explaining the role of an internal auditor and 2 marks for explaining the role of an external auditor. The difference comes in now, where we see that an external auditor expresses an unbiased opinion on the reliability of financial statements. They are there to enhance confidence, particularly to the shareholders of the company. So their responsibility is towards the shareholders and enhance their confidence in financial. Did not conduct himself according to the King Code. Okay, if you remember, in the first lesson, we defined corporate governance, which is the systems, the rules, the processes, and the procedures by which companies are governed. Okay, and how did Peter Moore conduct himself according to the King Code? So what were the issues with Peter Moore? Let's look at the scenario quickly. He inflated profits to boost his own financial incentive. That means he was behaving irresponsibly ahead of the interests of the shareholders. Okay, now to look at question 4.4. 4.4 asks, what type of audit report did Nicole Limited receive in 2023, and provide a reason for your answer. So if you remember, external auditors, they come to our company, they review the financial statements, and then they give or express an opinion on their findings. They can give 3 types of opinions, okay? So if you go back to the scenario, the key is in the first paragraph. It says Dion, which are the auditors, stated that they were unable to express an opinion on the reliability of the company's financial statements. Now, viewers, when auditors decide not to express an opinion, then we call that a disclaimer of opinion. It means that there were too many corporate governance issues, there were a lot of red flags, maybe some fraud, and maybe some unethical behavior that they've seen that would make them not want to express an opinion. Okay, so the solution for 4.4 says it's a disclaimer of opinion, as I've said. Now I'm giving you homework to go and check the 2 other types of opinions that an auditor may express. Auditors could not issue an audit opinion. This is a very adverse situation. They refused to issue the audit opinion, or they were unable to express the opinion on the reliability of the financial statements, meaning that these financial statements that have been prepared are actually not reliable. And then question 4.5 says, as a shareholder in the company, what concerns would you have regarding what happened? So put yourself in the shoes of a shareholder and think about the situation at hand. And what concerns would you have regarding this situation? It says mention 2 points for 2 marks, meaning that a point is a mark. Okay, as a shareholder, you must think about the impact of this opinion that the auditors have expressed on the company and the image of the company. Firstly, I said this should signal a lot of red flags. It's telling us something wrong. If we see that the auditors couldn't issue an opinion, it's telling us about corporate governance and poor corporate governance, poor ethics in this company, and therefore the image of the company is going to be tarnished first and foremost. This is going to drive away potential investors from investing in the shares of the company, and it might also cause the current market value of the shares to tank at the JSE. Why is the market value going to tank from this opinion? It's because some shareholders are going to lose confidence in this company. They are going to sell their shares. The shares are going to be in less demand, and therefore their market value is going to tank. Okay, now that looks at the position of the shareholder, but something else that may be of concern to us is this person, the CEO, Peter Moore. He did not behave in an ethical manner. He may face disciplinary measures, okay? We need to hold directors to account. He was abusing his power there, therefore he may face disciplinary measures. And he may also be voted out of office, okay? So the shareholders, AGM, the annual general meeting, they may vote him out of office. And unfortunately, there's going to be loss of confidence in the entire board of directors. We have come to the end of our lesson. I hope that you have enjoyed this lesson and that you have taken a lot from it. You can leave your questions on the comments, and don't forget to leave the name of your school so we can give you a shout out. Please share, recommend, and subscribe to our YouTube channel. Thank you for watching, and see you next time.